Good afternoon, everybody. My name is Carmen Wu, and I'm one of the lead financial advisors here at Egan, Berger Weiner. I'm sure many of you have already met me, and if not, I look forward to seeing you all at our client event in October. With that, I am here to present our speaker, but before we do that, why don't we go over some of the disclaimers? And if you can just take a couple of seconds to read them. Okay. Today, Julie Rison is the presenter. She is with Marsh McLennan Agency. Julie helps lead the Marsh McLennan Agency Mid-Atlantic Private Client Services Division. That's a mouthful. Julie works on high-level strategies and visions to expand the capabilities of Marsh McLennan Agency on a national level, both internally as well as with their carrier partners. Julie is a co-chair of the Marsh McLennan National Diversity, Equity and Inclusion Council and leads the Equity and Inclusion Council journey in the Mid-Atlantic region as well. She has over 30 years of professional insurance experience, specializing in the private client industry. Her experience has been focused around placing complex insurance programs, building new insurance relationships, and maintaining existing client and carrier relationships. Prior to joining Marsh and McLennan Agency, Julie worked for the agency in Minnesota, running their personalized and small commercial department before moving to Virginia in 2001. She also worked at BB&T Insurance and helped start their high net worth family risk management division. And in 2011, she joined Marsh and McLennan Agency to run and enhance their private client services division. And with that, I'm going to go ahead and have Julie, thank you for presenting today. And we'll have her start.
Thank you, Carmen. That is a mouthful. I didn't realize it was, but I appreciate the efforts. For those of you on the phone, thank you so much for joining. As Carmen mentioned, and I want to say thank you to Carmen for the invitation, as well as Mike for handling all the logistics behind the scenes. So today, you will notice I talk pretty fast. We have a lot to kind of go over, but I do want to kind of just give an overview of private client insurance, personal insurance, the market that we're in at the moment, some of the products that are out there and how they differentiate between different carriers and different agents, as well as hopefully giving you some nuggets that you can speak with your clients about when you're reviewing certain things with your clients, as well as what's a good insurance presentation if you don't have some claim stories, right? So that's when the rubber hits the road. So hopefully you'll get some info out of this. And like Mike said, by all means, please ask questions. I will leave some time at the end for Q&A as well. But I will probably go kind of high level on some of this stuff. And if you want to go deeper, by all means, I'm more than happy to do that either with the Q&A session or offline. So with that being said, we'll go on, we'll get it started. Mike, if you can kind of go through all three of these statistics real quick for me, thank you. I wanted to just kind of talk to you about the insurance industry in general, right? These are just some statistics that we found with the Insurance Journal as well as the Insurance Business Magazine, that nearly 60% of successful individuals are overpaying to be underinsured, and they don't even know it. Some homes are underinsured anywhere between 20 to 60%. And that's basically because things just haven't caught up, or that they were underinsured when they originally wrote the policies. And then 3 out of 5 American families are underinsured by an average of 20% for their insurance program, the entire program. That's including homes, autos, excess, everything. So, you know, this is really important information to know, because as we're going to talk about in a few slides, claims is where the rubber hits the road, and that's what insurance is for. So if people are completely underinsured or insured to this magnitude, honestly, the claims are not going to go well in the event that something does happen. So that's what insurance is for the claims. So we're going to go ahead and kind of talk about next about the claims advocacy and what that actually means, right? I'm going to give you a quick story that actually was one of our clients. Mike, if you can move on to the next slide. Let's see here. Actually, one more slide. That would be great. Thank you. Here's an example of our claims advocacy in action. There was a client that we had that had a $10 million lake home, and it caught on fire, and it was a complete loss. The whole thing went up in smoke, and it was going to take about a year in order to rebuild that home. But what was unique about this house was that there was some very unique architectural pieces and features within this home. And the client was really concerned that there was going to be some damage to those architectural pieces, and they really wanted to kind of save those while it was being rebuilt and use them in the next house. As a result, what we did was we worked with really closely with the insurance carrier to make sure that the home was almost surgically demolished piece by piece in order to be able to make sure and protect those pieces. The other thing that we did was we actually worked with the insurance company to advance them $5 million of this $10 million within 3 weeks of the claim. Because as you can imagine, things start moving quickly. They need to do down payments, all sorts of things. So we advanced them $5 million in order to start that claim. And the third thing that happened, that many times happens when a primary home is damaged, is that we needed to make sure that their secondary home that they had was refurnished to maintain their lifestyle and maintain that the coverage or the lifestyle and the comfortableness of that of the clients were being met. So in other words, it's really important with our types of clients that we actually help them in that claims process. And with this case, we were very lucky because the insurance carrier gave some coverages that we're going to talk about in the homeowners piece in a little bit, but the coverages were unlimited. And we're going to kind of talk about how insurance policies are not necessarily always created equal. In the insurance world, we actually have three, at least here at MMA, we actually have three different types of solutions. The first one is an individual solution, and that's going to be your standard home, auto, liability policy, flood, earthquake, wind, wildfire, which, by the way, is a hot topic at the moment with the hurricanes and the wildfires. Cyber, which we'll talk about later in the presentation, work comp for domestic employees, as well as EPLI coverage. EPLI coverage is employment practices liability, and that's in the event that someone has domestic staff that will cover if they're wrongfully terminated. Our clients are accused of sexual harassment or discrimination. That's what that EPLI coverage will cover. Watercraft, and then in kind of specialty vehicles, if it be motorhomes or motorcycles or four-wheelers. And then we do work with somebody internally that works specifically on individual life and disability. Those are our individual solutions that we really, most of our clients, I would say the majority of our clients have some, or if not all of those exposures. The second level and the second tier is more the specialty solutions. And that's going to be more for people that have passions, right? And we'll talk a little bit more about that in a few slides as well. But the special solutions are going to address any kind of private aviation, executive liability, if they sit on boards and they need directors and officers liability or some kind of E&O coverage, equine farm and ranch. That's a whole separate program that we have access to. And then fine arts or collections. It's one thing to have a valuable articles policy along with your homeowners that has some jewelry and some antiques or art to it. It's another level when we're talking about a $20 or $30 million art collection. Small business, some of them are within the homes, and then sports and entertainment. I actually have a colleague of mine that is in the Northern Virginia space that all her book of business, I would say 95% of her book of business is professional athletes. And they have special, unique exposures and risks that we need to make sure and cover as well. And then the last one is yachts. This isn't the regular watercraft or the regular boat that, that we have a fishing boat or something. We're talking about the mega yachts, the 200-foot, $20 million yacht. So those are our specialty solutions. And then we have a third tier, which are sponsored solutions. And this is really when we work with organizations to help with either their employees or their clients. We have a special program for family offices, or either multifamily offices or single family offices that specialize in that. We also have voluntary benefit solution. This is really where I'm not going to give too much information, dive deep. I could go down a rabbit hole in this, but it's more of a group excess liability program, which means that in the event that you have your personal excess policy, your umbrella limit on your personal liability, but for certain situations and certain groups, we can actually provide that in a group discounted type of program. And the underwriting guidelines are a little bit different, and some other things are a little bit different. So those are something that we offer, as well as just wealth advisory solutions of doing programs like this, or presentations, or being resources to our partners. This private client solutions, products, and client success stories. I think this is a good time for me to just kind of explain to you all what kind of market that we're in. I think that's important to kind of know that background real quick. I really try to explain this to people that the insurance market is very similar to a real estate market. In the real estate market, you have a buyer's market and a seller's market. In the insurance industry, we have a hard market and a soft market. Right now, we are in a hard market. And basically what that means is just like a buyer seller is, it's one has kind of the upper hand. Right now in a hard market, there's some characteristics that we're working with and we're trying to deal with at the moment. It's going to be increased insurance rates. Not sure if any of you have had a chance to look over your insurance program, but most likely the insurance premiums have increased some. But we're seeing anywhere between 20 to 40% rate increases across the board. In some states, like Florida, it could be anywhere from to 40 to 70%. And then in some states like California, the insurance companies are just completely pulling out of the program, pulling out of the state and not writing any new business at all there. Also in a hard market, the underwriters have the upper hand. The carriers have the upper hand, which means that when we go to market and we look at the insurance carriers and talking to them, they are more likely to decline a risk or an exposure or a client that they typically probably would have taken maybe 5 years ago. So not only are rates increasing, but also the underwriting guidelines are tightening up a bit. And so with everything going on, there's a lot of things that are happening that are the cause of that. It can be COVID did not help, I will tell you. The other thing is the catastrophic losses, and it's not just wildfires in California, which are spreading now to Colorado and Arizona and some other states, or the hurricanes, specifically in the Southeast. The catastrophic losses for an insurance industry are the freezing in Texas, the tornadoes in the Midwest. Right now, the Midwest is going through, parts of the Midwest are going through major droughts. So all of those things are actually affecting the insurance industry. The other thing with COVID, what's happened is that the supply chain has slowed down. So I don't know, I hope that none of you have had insurance claims, but if you have found that there are, the supply chain is a lot slower than what it used to be. I know I had gotten a car accident. Somebody rear-ended me in March, and I didn't get my car back until the end of June. So all of that soft costs of rental cars, if something happens to your home and they're waiting, twice as long to get the windows or the materials needed to repair that home, you're now having to, you might be out of that home for an extra, 6 months that you weren't expecting to. Those are all insurance costs that are now being accumulated into what we're considering a hard market. And the thing with that is a little bit different with our agency, and this is just independent agencies in general, just to kind of a flat foundation info, is we have the direct writers, which are going to be the State Farms, Allstates, Geico's of the world. And then we have insurance agents like ourselves that we work with several different insurance companies. So we work with insurance companies on behalf of our client. So when we do go out to these carriers and go out to market, we're getting several different quotes, several different terms and conditions and accommodations. And in the event that there is a claim, we actually are that advocate for our clients. Where when you're going to a State Farm, which it's a great company, don't get me wrong, it's just the products are a lot more limited than what we are able to offer on the, having 10, 15 different insurance companies that we work with. But also when you're calling them to talk about a claim or calling them to ask for advice, they're actually working for the insurance company. They're working for that carrier. Where and you're working with an independent agent, no matter if it's us or someone else, we're working on the behalf of our client. And we are that advocate. We are that person that is we're not, going to lean to one carrier or another, because what our job is to actually be that advocate for our client. So I hope that helps in foundation as we move forward. I'm just going to go through some lines of coverages, kind of give some examples, some differentiators, and then I can answer any kind of questions that you might have later as well. But typically, everyone has a homeowners, right? But not all homeowners policies are created equal. There are going to be some carriers out there that tailor to the high net worth, and those are going to be different than the carriers that tailor more to the middle market. We actually have both, because we do have some carriers that deal with the more of the mass affluent, in hopes that they are going to, grow into that more affluent type of client. But then for this presentation, we're going to talk more on the high net worth side. The high net worth side, they're going to give certain coverages that the middle market carriers are not going to offer. And that's going to be, for one, the unlimited guaranteed replacement cost, which means that you have a home insured for a certain value and it's a total loss, they're going to pay more than that. And we'll see that in the claims example coming up. They are going to give a large deductible waiver, which means that if one claim is more than $50,000, minus if it's a wind-prone hurricane deductible, if the one claim is more than $50,000, they will waive your deductible completely. And then the third thing is a cash out option, which is a great option, because many people of these high net worth families, they have multiple homes. And sometimes if there's a total loss, they don't necessarily need another piece of property. They can take the cash that is the value on the policy, the valuation on the policy, and they can do whatever they want with it. They do not have to rebuild, and they do not have to rebuild on that site. But what the insurance companies look at on these home policies are going to be, where is the home? Who's living in the house? What kind of monitoring systems or mitigation are they doing? Do they have alarm systems? If they, have, are they near a fire hydrant? Are they near a water source? Is it titled in a trust or an LLC? Some insurance companies don't have the capability of actually making sure that those trusts or LLCs are actually protected, not only with the property, but with the liability as well. So many of these, home policies just are not created equal, and sometimes you pay for what you get. One of the questions that we get asked a lot, especially recently, is the difference between replacement cost versus market value. And I'm just going to kind of give you a couple different examples, because I think it shows them well. The first example here is a home that was purchased in a historic home for $1.7 million. It had very unique features: original hardwood flooring, original hardwood molding, and just the original features of the house that required very, very skilled craftsmen to come in to try to reproduce. And if anybody has ever owned a home, an older home, it is, the 2x4s back then were really 2x4s, right? And so now they're like what, 1 3/4 versus 3 3/4 or whatever. You can't just go to a Home Depot and replace a door or a window because the measurements are off, the things are off. So you have to sometimes have very skilled craftsmen come in and actually try to reproduce and repair these homes. In addition to that, many of these homes are not up to building codes. So all of those things to go into the replacement cost of the home, in addition to demolition and all these different kind of things. So even though this home was purchased for 1.7 million, the replacement cost comes back at about 9 million. The other example is a home that was purchased. It was a 30,000 square foot home for $7 million. It had sophisticated audio and visual equipment. It was like a what we call a smart house with the whole house management system. It had been decorated by an elite interior designer with design wallpaper and custom paint finishes, and it had these elaborate grounds with a granite swimming pool and English gardens and a greenhouse, all this stuff. The problem with this is that the other homes in the neighborhood were very basic suburban frame homes, nothing comparable to this house. So for the market value, it was 7 million, but for replacement cost value to replace all those things and that structure itself was going to be about 21. So that's the difference between the replacement cost value versus market value. Market value also is based on supply and demand. So, we've been in a housing, this amazing housing market at the moment where, people go in and they offer, $100,000 more than the asking price. That's not necessarily the replacement cost. So we always like to explain that to clients as well. Quick example, I actually have a client that has been with me for about 20 years, and they have a home up in Maine. We call it the compound because there's a $10 million home that's on this piece of property, along with about 3 or 4 other homes that are between the $2 to $5 million range. Several years ago, probably about 15 years ago, they were having somebody paint the exterior of the home. And when they came out to do that, they were taking a steamer to try to get some of the paint off more easy. And everything was fine. But later that night, all of a sudden, they realized that the house was going up in smoke. And it was ultimately determined that from that steamer, there was a spark that had gotten into the insulation of the home. And it combusted and the whole house went up in smoke and it was a total loss. We had the unlimited guaranteed replacement cost. It cost 16 million to replace just the structure of that home. That's not including all the furnishings and the contents and everything. We had it insured for 10 million, but it cost 16 million to replace. A couple of reasons for that. One was they had just recently done, within the last 3 to 4 months, had done a renovation that they hadn't told us about, and the insurance carrier hadn't been able to go out there to do a reappraisal of the home. But also because of the time of, that it was. The replacement costs of homes are also determined by materials, gas prices going up, the transportation of getting those materials to the locations. A lot of people don't realize that oil spills increase the pricing of any kind of petroleum, will increase the pricing of PVC piping or asphalt shingles. So all of those products now are increased in pricing. So there was a couple different things that were going on there. But the positive end result of it was that the home was completely rebuilt. And even though it was $6 million over what we had it insured for. Collections and valuables. This is one thing that any home policy, no matter how good it is, are going to have limitations on certain categories of coverages. Those are going to be jewelry, antiques, fine arts, silver, guns, furs, and what we call collectibles or collections. Those collections could be sports memorabilia. It could be wine. It could be Chihuly glass. I had one client that had a whole $2 million collection of Egyptian artifacts with mummies and sphinx and coffins and all sorts of stuff. So whatever, that they're insuring, those collectibles or those collections, we are now terming them in the insurance industry more so of a passion investment. And many people, these passion investments can generate, it's a great investment tool sometimes, right? Wine, bourbon, those are some hot topics. But between 2005 and 2019, passion investments generated over about a 90% increase in returns. And these are not just collections, right? This is not just a nice piece of jewelry here or there. These are ones that actually the people are very passionate about. This is a lifestyle for them. They research everything. They know that category inside and out. It could be, I have some clients that are very passionate about collector cars. There was one instance that we actually had a client that came to us with a 1967 Ferrari, and it was valued at $10 million. And they had it on an auto policy. And so what I did was they were being charged $80,000 for that one vehicle, but they never drove it. It was in a secure, monitored, alarmed barn, basically is what it was. And they never drove it. It was their father's. And so it was just a passion of theirs. It was investment. What we did was we actually went to the carrier when we took over the account and asked the carrier if they could schedule it on the valuable articles policy like a piece of art. And so it gave more coverages. These coverages, there's typically a zero deductible. It's agreed value. And they also do give 150% guaranteed replacement cost on these vehicles as well, or on these collectibles as well. So there are benefits to having a collections and valuables policy. But with that instance with the Ferrari, we ended up placing it on a valuable articles policy, kept the liability on the auto policy in case they did want to drive it at some point, and it saved them over 60% premium. One of my clients, just a quick claim story. One of my clients actually had a wedding ring. It was valued about $20,000. This has probably been 7-8 years ago now. It was valued about $20,000, and they called me one day and said, "Julie, I can't find my wedding ring. I've looked for a month and a half. I just can't find it. What do I do?" So we went ahead, submitted a claim. The insurance company gave her the option of either giving her the $20,000, or do you want us to replace the ring? She said, "Give me the $20,000. I'm going to upgrade. I'm going to get bigger and better." Right. So she went ahead and she upgraded it, and she got bigger and better ring. And about 3 years later, she called me up and she said, "Julie, I found my ring." And I said, "Where was it?" Because again, no deductible, and she got the agreed value on it. So I said, "Where did you find the ring?" And she said, "I was cleaning out my closet and threw a pair of pants on the bed, and it fell out of the cuff of the pair of pants I threw on the bed. I was going to give it to the Goodwill." I was like, "Oh my gosh." She said, "What do I do?" And I said, "I don't know. No one's been so honest before. So let me call the insurance company and see what I can find out." I called the company and they said, "Tell her to either send the ring back or send us the $20,000 back, and we'll expunge it from the record like the claim never even happened." So it's those types of things that are all covered, even if you just plain lose it. Autos and exotic vehicles. This is something that typically on a standard auto policy, the liability will pay out the same. The comp and collision, kind of the types of losses that they are paid out are the same, but not just like the homeowners policy. Not all auto policies are created equal. There are some differences that, especially with our high net worth clients, that we need to really kind of make sure that we are addressing. For one is the agreed value. The high net worth insurance carriers will offer agreed value on auto policies, which means that instead of trying to haggle back and forth with the blue book, that they'll just write you a check, stroke you a check. In the event that there's a total loss, they'll just stroke you a check for the amount that we have it insured for. This, just as an FYI, is actually very different. We're seeing a trend very differently in the past 18 months than it was previously in the last 25, 30 years that I've been in this business, is that they used cars on these renewals, the values are increasing instead of decreasing. Typically on an auto policy, the value depreciates, right? Not recently. Because of the shortage in the auto industry, the value of the used cars are actually increasing at renewal time. The other big thing is going to be OEM parts. We have some carriers that are good carriers, but they don't offer the OEM parts. They will, in the event that there's a claim, they only offer aftermarket parts to these clients. And with the high net worth carriers, they all offer the original manufacturer parts. And then the other thing is more the high value vehicles or the antique auto vehicles. They are very unique vehicles. And so we do have some carriers that specialize in that, that they, but they do take into consideration who owns those vehicles. It's not going to be an 18-year-old that's going to, they don't like 18-year-olds that own Ferraris or Lamborghinis, right? Because it's very unique how to try to actually drive those vehicles. Sometimes they can be a little too much to handle. So they want to make sure that they have the proper drivers with those vehicles. The other thing that a lot of these high net worth carriers will offer on an auto policy is worldwide liability, which is not what typically most auto policies will cover. They will cover in the event that you rent a vehicle or borrow a vehicle overseas. And so that's something that is very unique with the high net worth carriers. What's an auto explanation without an auto claims example, right? So this one is actually pretty unique. We actually had a client that was having coming home from grocery shopping. She had just gotten her new car. It happened to be a Maserati, and she stopped really quick, and groceries went everywhere. Groceries went all over the car. She got home, she was picking up everything, thought she had gotten everything. Little did she know that there was a quiche stuck underneath her seat of the vehicle. The claims, because it was a high net worth carrier, the claims department actually arranged for new car, because she went away. She went away on vacation for 3 weeks, came back, went into her car, and it just smelled to high heaven. And so we submitted a claim, and the insurance carrier actually arranged for new carpet to be shipped from the Maserati plant in Italy to recarpet the vehicle, and they steamed the whole car to make sure that the smell was removed. But that was something that not a normal State Farm or Geico are probably going to do for you. So those are just some examples how high net worth insurance carriers will go above and beyond. Liability. So just so that I can kind of get this out there, when I say excess liability or umbrella policy, I use those terms interchangeably. They're pretty much the exact same thing. There's a couple nuances that us insurance geeks know, but and if you ever want to know them, I'd be more than happy to get in the weeds. There's not many of them, I can tell you that. But the liability policy is where we see probably the highest number of uninsured people, or people that don't have enough insurance of this type. The liability, excess liability policies are going to go up and over your primary policies, which would be your primary home, your auto, if it be a boat, if it be a rental piece of property, a secondary home, whatever it is, you have your primary policies that cover that exposure and that risk. But then you have this umbrella policy or the excess liability policy that goes up and over those items and that liability coverage. So this policy actually covers more than what the home policy or the auto policy will cover. It does cover libel and slander. It covers personal injury, and the defense costs with these high net worth carriers. The defense costs are outside the policy limit and unlimited. So when I'm talking to clients about, getting a liability, excess liability policy, I always tell them, listen, you are purchasing the limit of liability for a catastrophic lawsuit, but you're also purchasing this policy for the unlimited defense costs, because sometimes the defense and paying for that can be just as much if than the actual lawsuit or judgment or settlement itself. This insurance will actually defend you until there is proven that there is no coverage. So even if it's a fraudulent or unfounded accusation, the insurance company will defend you until they determine that there was no case or that there was no coverage. This is a situation where there was an incident with a youthful operator. This is one reason why insurance carriers kind of look at the excess liability policy. There's a lot of things that kind of go into rating that, and that's going to be, how many homes do they have? How many recreational vehicles do they have? How many autos do they have? Do they have a swimming pool? Do they have teenagers that are driving? What do they have, right? That are going to give them the biggest exposure of being sued. This is a situation that a client's teenage daughter had lost control and hit a pedestrian at a bus stop. The pedestrian had sustained major injuries and required extensive rehab. This claim actually ended up being over $2 million. The underlying policy paid out over $500,000, and then the excess liability policy was a $1.5 million settlement. I will tell you that, she lost control, yes, but I will tell you that many times this liability policy, people will say, well, I don't have those high exposures, right? Things can happen that are just truly accidents. On a personal note, my son, I have 2 boys who are now grown, but at the time, my oldest was playing soccer at college, down towards Tidewater, down towards Virginia Beach area. My husband and my younger son were actually driving, and I don't know how familiar you are with 64, but it's very much like 95, right? It can stop on a dime. And they were driving. My son was following my husband because he was having to come home later that day to go to work. So they were following each other, and all of a sudden traffic stopped quickly. My husband veered off to the shoulder to not rear end the person in front of him. My son, who was paying close attention, swerved not to rear end my husband, but then was afraid that he was going into the other lane and swerved back and overcorrected and ended up hitting my husband anyway. Flew my husband into the woods, so much that his car was sideways and he had to climb up the driver's side door to get out of the vehicle. And with all that happening, he watched my son flip 3 times, bumper to bumper, right in front of him. He flipped his car three times. And I tell this story because it was a happy result. Neither one of them were injured, right? Both cars were totaled out. But I tell that story for 2 reasons. For one, both of them were paying attention. It wasn't like they were being reckless, right? And something could have happened. And the other thing that was a positive out of it was that it was only those 2 vehicles that were in the accident. That very well could have caused a 10-car pileup, and we could have been sued by multiple parties. And there's no way that my auto policy would have paid out enough to for all those lawsuits. So it's a good thing that I had an umbrella policy. But I tell that story because it could be just icy roads, it could be slippery roads, it could be a rainy day. It doesn't have to be somebody that's not paying attention or that's being reckless. It could just be a pure accident, and that's what the liability policy is for. You all do a great job of trying to preserve your clients' wealth, if it be for retirement or for the next generation. We create the program to protect it against these catastrophic types of events. Cyber versus theft, and this is going to be the last coverage that I talk about, and then I can take some questions. But cyber versus ID theft. ID theft is very much, very often put on homeowners policies, and it's built right into the homeowners policy. The big coverage now is cyber theft. And this is going to cover in the event that someone either is using some ransomware or some malware, or gets some, cyber, gets into your Wi-Fi, something like that. So this is going to also cover loss of funds. It's going to cover cyber attacks. It's going to cover cyberbullying. If anyone in your family, especially if you have teenagers or young people, this coverage actually offers counseling and therapy for cyberbullying victims as well. And then any kind of crisis management or reputation restoration in case some of this stuff gets out. And if they, somehow get access to financial statements, bank statements. We just had a few weeks ago, a client that had personal photographs stolen off of their phone. So those types of things, that's what cyber is. Identity theft is just basically your credit card, right? And it's document recovery and it's credit recovery. That's not cyber. And my last example for the day, and then I can take questions, is I actually had, and I apologize, this is the wrong example. So I have another personal example that I'm going to share instead. But I actually I was presenting to this with, to some of my colleagues down in Charlotte, North Carolina, and presenting the cyber coverage. And he came to me a couple days later and he said, Julie, I'm so glad that you were talking to us about that, because I was actually in the process of buying a boat. And I was buying it from a friend of a friend. And so we had been emailing back and forth. And after I had gotten out of that meeting, the next day I got an email from him saying, hey, listen, we got hacked. And so we changed banking institutions. Can you please just go ahead and wire the funds to this bank and this account number instead? And he goes, and because of your presentation, I looked at the email, and the email was a fraudulent email. What these people do is they actually will hack into your Wi-Fi, and they will just monitor you for a month or two, or maybe even longer. They will get the way that you talk. They will get the way that they'll duplicate the way that you speak or the way that you write emails. And they will wait they'll just monitor it and not do anything. And then all of a sudden they'll wait for the right opportunity. And they'll use emails that are very similar to the emails that you're used to, but they'll use maybe a number 1 instead of a lowercase l, or they'll use a 0 instead of an O. And so to look at just glance at the email, it's very similar, so you don't realize it, but it's one of those things that you just need to be very, very mindful of when you're actually exchanging funds or who you're having access to get into your systems. So those are just, I talk really fast and I apologize, but there was a lot to get to. And I just really kind of wanted to give you kind of a little snippet for each type of coverage, so that you had some kind of maybe some context to talk to some of your clients about when you're going through the insurance review with your clients. So with that being said, Carmen, Mike, anything that you want me to address or anything you want me to talk about?
Not particularly. I think you've addressed a lot of different issues. We haven't, we have one question. Hold on a second.
Do I work with long-term care insurance? We do. I personally do not, but I do have a colleague that actually works with long-term care as well as life insurance. And there's a hybrid policy out there that actually with life insurance that turns into long-term care that a lot of people are now getting. But if you're
yeah, and so just so that you know, for everybody on the line, David Beck, who's here in our office, does a lot of the long-term care insurance as well.
Then I would go to David.
You. And let's see if we have any other questions. So, the last point that you made, Julie, with regards to the cybersecurity, how is that written up? Is it a separate policy or is it a policy within a homeowner's insurance?
Nope, it's typically it's connected to either a homeowner's or a liability policy, an excess liability policy, one of the two, depending on the insurance carrier. So not all insurance carriers offer it, and not all insurance carrier offers it in all 50 states. So for example, I know some of our high net worth insurance carriers, they don't offer it in all 50 states, but if somebody has a second home, let's say in a state that it is offered, we can write it on that policy. in order to be able to get the coverage, because it's a worldwide, it covers the insured and not necessarily the location.
I think that for now, let me see if we have any other questions. We do not. So given that, if any of you who are listening to our webinar have any additional questions that you may have, please send them to your advisor and we will forward it, Julie, if that's okay, to you.
Sure.
So that you can answer any questions that they may have.
Absolutely. I'm more than happy to help. I mean, even just answer insurance questions or how things work or the industry, or, you know, it's hard for us to say if something is for sure covered or not with hypotheticals, but it's one of those things that we can actually get a good idea.
Thank you, Julie, again. You, as usual, you're very helpful. Thank you for presenting to us. And I know that you will be at our client event as well, correct?
Yep, I will be there. I have it on my calendar.
All right, excellent. Well, thank you all for joining us on our third webinar of the year, and we look forward to having you join us on our fourth quarter webinar. We look forward to seeing you all at our client event. And with that, I will say thank you and have a great rest of the day.
Thank you.